In Southeast Asia, digital lending is framed as financial inclusion. It's fast approval, no collaterals, expanded access to credit. But however, inclusion really depends on how risk is defined. And so today, I'll be analyzing digital credit scoring systems based on a 5-layer framework or model. It's not really to analyze whether AI systems are good or bad, but to assess what are the assumptions on who gets capital in emerging markets. I've been living outside Metro Manila for 3 years now, and it's been an eye-opener for me. The people I meet here, a lot of them doesn't have regular income. They're freelancers, they're small business owners, they're fishermen, farmers, surf instructors. And therefore, income is irregular, cash flow fluctuates, financial rhythm isn't monthly. So when they apply for loans, the system would definitely evaluate their financial data or behavioral data. It's gonna be fast approval or rejection. But then the question is, what's really being measured here? Digital lending heavily relies on infrastructure, and that includes mobile penetration, app ecosystems, payment traceability, telecom stability, and platform compliance systems. But in most Southeast Asian contexts, connectivity is actually uneven. There's a huge rural-urban gap when it comes to connectivity. Philippines and Indonesia are on catch-up mode, but then Cambodia, Laos, and Myanmar remains challenged. Just to share with you, whenever I go to surf trips in the far rural locations here in the Philippines or in the islands, I had to rely to PisoNet Wi-Fi. So there's a machine where I insert coins and I can access the internet for like about 10 minutes, 15 minutes, 30 or an hour, and that's it. So there's progress. However, this just goes to show that in this types of markets, device quality varies and data remains fragmented, or data trails remain fragmented. Not everyone uses digital. To be honest, I was just in Ilocos recently. A lot of institutions outside Metro Manila doesn't use digital. Infrastructure shapes risk modeling outcomes, and not all financial behavioral data are digitally visible. This now means that there's invisibility when it comes to financial behavior, which is now becomes uncertainty and is translated to risk. Most credit models predict or reward predictability, and that means regular income, consistent transactions or cash flow, stable financial behavior. But then in informal economies like the rural areas here in the Philippines, variability is normal. If a system flags irregularity as danger or risk, it may now penalize this economic reality that we are facing. AI systems aren't judging our character. There are rules that and thresholds that are being encoded there. And the real question here is, who defines these rules, this stability, and on or what labor model are they using? And how are the infrastructure gaps being addressed? There are three major players in the ecosystem. That includes digital lenders, investors, and platforms. Digital lenders optimize for default reduction. Investors wants to maximize their portfolio, and platforms are benefits from scalable automation. But the question now is, who bears the cost when systems misclassify? Is there a way to appeal the process? Is there a transparent explanation? Is there a human review or a regulatory audit? Inclusion tools sometimes can just become tools for exclusion as well at the end of the day if there are no correction pathways. And even if there's efficiency, if there's no oversight, then it just concentrates power. No system is perfect. It's no longer accuracy rates at this point. It's how systems recover from errors. And if someone is denied, can those who develop the systems explain why? Is there a way to correct it? If the data is misinterpreted, can it be challenged? In emerging markets like the Philippines, digital exclusion can just translate to informal borrowing, high interest debt traps, or financial instability. And we don't want this. Resilience in systems would determine if systems really support mobility or locks people out. Digital lending in Southeast Asia is not inherently inclusive or exclusive. It depends on the design, the assumptions, the governance that's being implemented. And the question now is there a corrective mechanism? It's no longer a question of if these financial systems or the AI behind it can expand access to credit. It's now a question of what kind of economic stability is being encoded. And that's how I believe responsible digital system design begins. If you care about digital infrastructure, governance, and responsible tech, I'll catch you in the next episode.